GlobalX on the topic of thematic investing, which essentially means you investing in trends that you feel will change the world. So a few months back, StashAway launched a set of thematic portfolios in Singapore, Malaysia, Dubai, and Hong Kong. And through those thematic portfolios, you are able to have not only exposure to some game-changing trends like technology enablers, future of consumer tech, and healthcare innovation, where we leverage GlobalX ETFs as part of the portfolios, but you're also able to manage your risk profile through your thematic investing, so that you really stay true to the core risk that you are able to digest over a long-term period, which is especially important for thematic investing. So this evening's webinar is very well timed for end of the year, and to have a look into what 2022 will bring in the topic of thematic investing. Which innovations are expected, how you can think about gaining knowledge around them and really benefit from that knowledge. So the core of our discussion today will be the newly published and the GlobalX report, Charting Disruption 2022. And for that, we're super happy to have Jay Jacobs, who is the head of research and strategy at GlobalX, joining us today. Thank you very much, Jay, for your time, and really looking forward to hearing the insights. And along with Jay, we also have our co-founder and CIO, Freddie Lim, with us. So how we'll be starting off is Jay has a few insights over the next 15 to 20 minutes to share with us. And then I will be taking posing a few questions to Jay and Freddie to get their thoughts around the topic, and then we'll also be opening up to Q&A. So please, throughout this time, as your questions come up, please do post them in the Q&A, and after the panel discussion, we'll be happy to have Jay and Freddie take up those questions as well. So again, I won't take more time. Jay, over to you.
Perfect. Thank you, Nadini, and thank you everyone for joining today's webinar. I am going to share my screen. Just bear with me for 1 minute here so I can share some of these slides with everyone. And let's make this full screen. Nadini, can you just confirm that you can see my screen and hear me?
Yes.
Okay, perfect. Great. Well, thank you everyone for joining. As Nadine mentioned, my name is Jay Jacobs. I'm the head of research and strategy at GlobalX. For the better part of the last 5 months, we've been working on what I will be showing a few slides of today, our 2022 Charting Disruption presentation. This is a concept we've been working on for several years, really kind of a chart book that tries to bring data and insights and kind of this forward-looking view to the thematic investing space. This year, we've done it kind of bigger and hopefully better than ever before. We've organized Charting Disruption into 8 different chapters, where we brought in experts from different parts of academia, consulting, the investing world to talk about their own views of these themes, while we also add our own research team's views. We did forecasts, we did surveys, we have what we call kind of unexplored insights or ideas that hopefully you haven't seen kind of anywhere else before, all in this presentation of about 123 slides. So we will not go through all 123 slides in the 15 or 20 minutes we have today, simply not enough time. But if you like what you see and you want to dig into this more, this is available to everybody, anytime around the world at chartingdisruption.com. You can download this presentation and explore it for yourself. So I'm going to skip ahead and move around pretty quickly. But as I was mentioning, we brought in several subject matter experts to help us with Charting Disruption this year. Eric Brynjolfsson, the professor of the Stanford Digital Economy Lab, Rick Edelman, formerly of Edelman Financial and head of the Digital Asset Council, Rama Asnam, a clean tech energy investor, and Amy Webb, a quantitative futurist. all sharing their ideas on these themes, as well as our own research teams. So I want to talk about maybe 2 to 4 themes in particular that we see as reaching critical inflection points in 2022 and beyond. And this is, you're probably going to hear me use the word inflection point several times on the call today. But if we really think about, thematic investing and what kind of serves as a major accelerant for thematic investing, what you often see is a theme like, call it robotics, call it clean tech, call it blockchain technology, that sees a steady amount of growth as technology gets better, as costs get lower, as more people kind of adopt that technology. And then suddenly something happens that changes the entire trajectory of that theme going forward. It could be a huge change in prices, just a plummeting of the cost of a solar panel suddenly makes it accessible to everybody, building a new home to put a solar panel on the roof. It could be a changing macroeconomic environment. So suddenly the technology that didn't have as much need suddenly becomes very necessary. Think about cryptocurrencies and how maybe that view has changed a little bit as we've seen the increase of liquidity around the world and some of the inflation we're starting to see. Or maybe it can just be the technology itself gets better, that previously it was okay and it made the leap from okay to suddenly a can't miss technology. So inflection points are really, really key pieces of thematic investing. The idea being you want to invest early enough that you get in before that inflection point, and certainly hold on long enough to see the entire growth that can materialize after that inflection point. Now in 2022, the entire world is hitting an inflection point, hopefully, because we are exiting or in the waning days of this pandemic. We don't know that for certain, but hopefully I think we're trending that way. And it means the economy is trying to get back to some sense of normal. But what is going to be normal in 2022 and beyond is not going to be the same thing that was normal in 2019 and before. We've already had kind of this new experience that has changed the way we viewed public health, the way that we viewed society, the way that we viewed priorities. We've changed our habits during this pandemic, whether it's from work from home and the flexibility that that affords, or if it's the types of technologies that we use in our everyday lives. So there's a lot of changes to the economy that have happened and kind of been brewing under the surface for the last 18 months. And as we exit the pandemic, we're going to start to see which of those technologies are really set off on this new inflection point to continue growth beyond COVID-19, or which ones maybe were solely useful during the pandemic, but maybe not so useful going forward anymore. One of the key technologies, and you see a slide on robotics and artificial intelligence in front of you, that we see as hitting that key inflection point is robotics and AI. And there's several reasons why, but just for a very basic understanding of what is robotics and AI first. Basically, robotics is the body, AI is the mind of a machine. Over the last even 50 years, believe it or not, we've had robotics advance to the point where it used to only be able to pick up very heavy, very kind of awkward pieces of metal and put it in another place. Now robots are smart enough to and delicate enough to pick up something as fragile as a strawberry, to know that a person is near it and change its speed, to change where it's going, to interact with a human being, to download live updates online. So suddenly we have robots that have gotten very smart, very capable, and can do things that no one ever really thought robots could do before. But in the macro environment is where we're starting to see the biggest inflection point. It's not just about the technology that's getting better. Robotic technology has been getting better and better and better. But what we're starting to see is a macro environment that is starting to move the pendulum in favor of robotics. At a very basic level, we're seeing the dispersion between the cost of a robot and the cost of labor starting to widen more and more. Right now, we're seeing rising labor costs around the world, but it's pretty acute in the United States, which means it's more and more expensive to hire people. Whereas generally over time, what you see is that technology tends to get cheaper. And you can see this on this chart here. And we've included China as well, which has experienced very high increases in wages in manufacturing compared to the United States and compared to the cost of robots. You can see that every year that goes on, basically labor is trending more expensive, robots is trending less expensive. So at a very basic economic level, as we see that acceleration in inflation, that is likely to make robots come off as even cheaper than before. But on top of that, a few other factors. We still have supply chains that are disrupted. So a lot of companies around the world are looking for how to make their supply chains stronger. And often stronger means kind of shortening that supply chain. So if you're a US company that used to depend on goods passing through several different countries before it reaches the United States, how do you shorten that supply chain and just do manufacturing in the United States? But how do you do that in a cost-sensitive manner? That's going to point towards robotics and artificial intelligence. On top of that, we still have very low interest rates, which makes it very inexpensive for companies to borrow and invest in robots. Beyond that, maybe in kind of a longer term fashion, we have aging populations, most acutely felt in Japan, but also in places like Europe and China and in the United States. We have a rising population that's not being, an aging population that's not being kind of matched with a huge influx of youth that would be kind of the next labor force. And of course, as the technology gets better, the quality of what robots can do and the breadth of what robots can do is getting better and better than ever before. So all of this kind of creates a major inflection point for robotics going forward. The costs, the quality, the necessity, the ability to implement robotics and artificial intelligence is all likely to accelerate in 2022 and beyond. You can see what impacts this might have on the economy going forward. Previously, when you look at certain groups of goods that have been sold in the United States and beyond, what we've seen historically is that goods that have gotten very expensive over the last 20 years or so are ones that couldn't be outsourced, that couldn't be moved to lower cost labor. So cell phones have relatively gotten much cheaper, computers, TVs have all gotten a lot cheaper. But things that have to be produced in an expensive place like the US or in Europe or perhaps even in Singapore have gotten more expensive: medical care, education. What we believe going forward is that these services that have not been able to benefit from any of the outsourcing trend over the last 20 years could actually benefit from robotics and AI going forward, because we're now getting to the point where AI is so good that it can start to automate those services. It can help teachers develop teaching plans, or it can help with grading, or it can help just reduce the amount of time that teachers need to spend on their classes, which can help dramatically reduce the cost of education. AI can help pharmaceutical companies develop new drugs. It can help with surgeries. It can help with simply cleaning or providing security or nursing services within a hospital. So suddenly you have these industries that have never been able to really benefit from cost-cutting measures can skip ahead to the artificial intelligence generation and start to use those technologies to reduce costs. So we think this could be a very exciting inflection point as robotics and AI get used more and more across the economy, that previously very expensive, high inflation parts of the economy are likely to come down with the introduction of AI going forward. I'm going to skip ahead pretty quickly because I know we don't have a ton of time today to go through 123 slides. So I'm just going to touch on some of the key kind of forecasts and interesting insights that we have in this deck. One area we've gotten a lot of questions about, and we will talk more about with mobility, is really what is the state of autonomous vehicles. So speaking of another industry where AI has very high potential, of course, is in the transportation space, where you could start to see autonomous vehicles, autonomous trucks, autonomous boats, planes, whatever form of transportation. We are likely working on some form of AI to automate that process going forward. What you could see right now is that the way that we kind of judge the quality of autonomous vehicles is how many miles can a car drive before the artificial intelligence is disengaged, meaning how far can this car go before it gets in trouble? When it gets in trouble, it could simply be a delivery van that's double parked in the middle of the road and the car doesn't know what to do. It could be that the road is closed and has to find a new route. But right now, what we're seeing with two of the leading autonomous vehicle companies is it's right around 30,000 miles per disengagement, which is very, very strong. But what you need in autonomous vehicles is basically flawless execution. If you want level 5 autonomous vehicle technology, where you even remove the steering wheel from a car and it is purely going to take you from point A to point B with no questions asked, you need to see continued massive improvement over that. And what we are forecasting in the left-hand chart here is that by the end of this decade, by 2030, we should be able to see some of the leading autonomous vehicle technology go as far as 200 to 300,000 miles without a disengagement. That is basically 10 times around the world in terms of the amount of miles that car can drive before it would ever reach a disengagement situation. So this is obviously quite exciting. This is all being developed by continued investment in LiDAR technologies, radar technologies. If you are in San Francisco at any point, you probably see several different autonomous vehicle cars on the road navigating the famously difficult streets of San Francisco to determine how to get around different obstacles. But we are expecting to see, again, back to this idea of inflection points, a major inflection point in the quality of autonomous vehicles before we see disengagements. So what does all this forecast mean for the autonomous vehicle, or sorry, for kind of the broader robotics and AI space? As I was mentioning, we follow this S-shaped pattern of adoption, the slow initial adoption until costs fall, technology gets better, and you start to see the acceleration going forward until basically everything that can be automated or turned into a robot is automated and turned into a robot. So right now, we're basically at that lower left-hand dot at that $16 billion marker. We expect over the next 10 years, we will see an acceleration of adoption to about 37 billion in industrial automation. But that is still a small fraction of the total market here, which could be as much as 355 billion. There's a huge potential market for industrial robots. It's just, this is not a function of robots growing too slowly. This is a function of, this is such a big market to disrupt. It will take a very long time to reach kind of full penetration of industrial robots. But even just seeing more than doubling in industrial robotics sales over the next 10 years is going to be very, very fast growth for what historically is the industrial space, not the fastest growing area of the economy. So this should all point to some of the very exciting things that we're seeing in the robotics and AI space. Now I'll skip ahead to a different section, and sorry if this is moving at warp speed here, but I just want to make sure we touch on a lot of the exciting areas of this deck. I want to talk a little bit more about mobility theme for 2022. Here we go. So one of our other key themes for 2022 is advancements in mobility, and really within the advancements of mobility, aside from some of the things we were just mentioning about autonomous vehicles, is going to be the shift from internal combustion engines to electric vehicles. And this is something we've been looking at for over 10 years at GlobalX. You can see some of the rapid price declines that have already been happening in batteries that have suddenly started to make electric vehicles more and more affordable. But affordability is just one piece of the puzzle. Again, just like we've talked about how it's a mixture of cost, it's a mixture of sometimes political will, of manufacturing, of consumer adoption. That's very much the case in electric vehicles as well. We want to see the innovation that makes batteries better and cheaper. We need to see commitments from major car companies to come out with car models that are electric. There's not that many car models in the world that are actually purely electric and electric platforms. Until costs get sustainably low, meaning that the cost of an electric vehicle is off the car lot, cheaper than an internal combustion engine, you still need a regulatory environment that's very supportive. We think that that inflection point is likely to happen in 2024. And of course, consumers need to want to buy these things. An electric car is different from an internal combustion engine. How you charge it, how you maintain it, what the considerations are when you drive it. So all of these things need to happen for electric vehicles to become the predominant form of transportation going forward. There's a few things that we're looking to happen on the cost side of the equation, which, and we'll go into some of the survey results, but we asked about 500 people, what will it take to get you to buy an electric vehicle? And a lot of people said, once it's cheap enough, I will buy an electric vehicle. So how do we get to once it's cheap enough? One of the trends that we're seeing is that we're starting to see changing battery chemistries, and not to get too much into the details of this, but effectively you have very high-end batteries that are nickel rich. They're called NMC batteries. And you have certain batteries that are iron based, LFP batteries. LFP batteries are much cheaper than nickel-based batteries, and it's kind of an older technology, but because everyone coming out with electric vehicles right now are predominantly coming out with sports cars like Lucid and Tesla and even Mercedes, they're all focused on the NMC batteries. Our prediction at GlobalX is that what's actually going to be the bigger differentiating technology for electric vehicles going forward is going to be the shift to LFP batteries. Anyone who follows the space very closely will note that just in the last few months, Tesla has announced that they're starting to shift to LFP batteries. A lot of the car models built in China right now are based off of LFP. Even a lot of the models built in Europe right now are based off of this LFP battery technology. What we believe that this is going to do is it's going to continue to bring those prices down for electric vehicles to make them more and more affordable. In fact, we could actually get LFP batteries are about a quarter to a third cheaper than NMC. So if you think about, right now you have electric vehicles that are mostly in the kind of luxury segment of the car market. To bring that down to the mass market, we believe LFP is really the only way that's going to happen going forward. So that's something we're keeping a very close eye on. But beyond just the cost of that battery, we also have to think about what is the convenience of owning an electric vehicle. And right now, one of the major inconveniences of owning an electric vehicle is the lack of charging options. This isn't the case everywhere, and some states and some countries have done a very good job of building out charging infrastructure. But in many places, it's still very difficult to get a charge. If we look at the United States, you can see how many average road miles there are per electric charging station. If you go to some of the kind of less electric friendly states, you could be driving as much as 1,000, 2,000 road miles before a charging infrastructure is available to you. That's obviously too far. There's no battery in the world that in a car that's that big. But at least in the United States, we're starting to see that shift very dramatically. We have the Infrastructure Investment and Jobs Act that just passed, the $550 billion infrastructure bill. Our forecasts estimate that should multiply the amount of charging infrastructure in the United States by over 7 times. So that will make a hugely denser infrastructure charging network in the US to charge any type of electric vehicle. So suddenly, you not only are electric vehicle prices coming down, which make them more affordable, but actually this has kind of the double impact of you don't need as big of a battery if charging is readily available, which will make electric vehicles even cheaper. And then on top of that, this will make them even more convenient. So I'll skip ahead, and this might even have to be our last slide here, because I know I'm going long on some of the intro discussion here. But we asked we conducted a survey of consumers to understand what it would take for them to buy electric vehicles and what their concerns are. I'll start with the right-hand side. If an internal combustion engine and electric vehicle are the same cost, which one would you buy? 37% of respondents said they would buy the electric vehicle. So that's the power of cost parity, which we could be reaching in just a few years in electric vehicles. That would be a huge inflection point for the sale of electric vehicles going forward. So we also asked people on the left-hand side, what are your reasons for not considering buying an electric vehicle? And basically, 1 is related to cost and 2 is related to charging. Concerns about range and hassle of charging were 2 of the top 3 issues. Both of those will be addressed by advancements in battery technology, as well as that densification of infrastructure charging networks. And then high initial cost, we're seeing that come down regardless because of the advancements in battery technology. So we can tell from the survey work that electric vehicles are really likely to experience a massive increase in their market over the next 10 years, jumping from a $120 billion market to a $1.4 trillion market by 2030, for all the reasons that we've been discussing. But this is a theme that is clearly in that inflection point of technology, in cost, in regulatory environment, and consumer adoption. Nadine, I was thinking I would pause here because I know I've already been going for about 20 minutes or so, but I can kind of X out of my screen here and open it up to more of the panel discussion.
Sure, but if you have any specific theme you would still like to cover, Jay, please do go ahead.
All right, I'll do
super interesting. So yeah.
Excellent, no problem. All right, I'll do one more here. Just let me reset my screen. We'll talk about blockchain and crypto technology.
Perfect. Thank you.
Here we go. Okay, hopefully this can still be seen. So another chapter that we've been focusing on is blockchain and cryptocurrencies. That shouldn't be too surprising to everyone. You can't open the news, you can't open Twitter and not hear someone talking somewhere about cryptocurrencies. We've done a lot of work around just simply trying to kind of classify the cryptocurrency space, making sense of all these different coins and tokens that you're hearing about, what they do, how they compare to each other. But the bigger trend that we're seeing in the cryptocurrency space right now is the institutionalization of the space. So on the left-hand side here, you can see Coinbase, one of the leading crypto exchanges. What percentage of their dollar volume traded on their platform is from institutions versus from retail? There's a major misconception out there that all of this crypto noise in the world is happening from retail investors. And that is not the case. And frankly, it hasn't been the case for a while, because it's all the way back in 2019 where you started to see that institutional traders made up the majority of trading on Coinbase's platform. But now institutions make up almost 3/4 of the volume on Coinbase, even as volume has surged on that platform going forward. The implications of this is really important, because I think in the back of people's minds, at least in the back of many people's minds that I've been speaking to, is that there's still a fear that crypto could be the next most disruptive technology in the world, or it could go to zero. And there's not a lot of room in between for kind of those two viewpoints. But when you see that amount of institutional money coming into this space, it means that you have some of the biggest, most sophisticated investors that are now supporting this asset class and participating in this asset class. And that in itself helps, whether it's Bitcoin or Solana or Ethereum, kind of reach a certain escape velocity where I don't believe it's likely to go back to zero anymore, because you have so much money invested in the space, kind of hoping to institutionalize it and bring it out to the broader market. So why are institutions interested in cryptocurrencies? From a very basic perspective, I don't think it always has to do with returns. Of course, everyone wants to maximize returns when they can, but they also want to minimize risk. And what we've seen from Bitcoin over the last several years is that it's actually a very helpful diversifier in a portfolio. Whether you're comparing Bitcoin to the US S&P 500 or the NASDAQ 100, or even MSCI ACWI or other asset classes, you see very low correlations, meaning just the presence of Bitcoin in a portfolio, if you scale it properly, can help actually reduce risk, because it's going to just behave very differently. Now, that's not the case if you're buying 100% crypto, or you're buying crypto on leverage, or doing very risky activities. But placing crypto alongside other asset classes can help reduce risk if done appropriately. Now, the challenge for a lot of investors, and especially institutional investors, is that we still kind of have these two distinct worlds. We have the traditional financial world where you can buy equities on a stock exchange and people are comfortable with that. And then you have this new emerging disruptive world of buying cryptocurrencies on crypto exchanges, and how that's custodied and transferred, and how everything kind of works in that environment. One of the biggest hesitations for more institutional adoption right now is, how do you blend those two worlds? How do you invest in crypto, but in a regulatory environment that institutions are comfortable with, or within just an operational environment that institutions are comfortable with? So where you see a lot of institutions directing some of their investments these days is not directly to crypto, but looking to what I would call the picks and shovels of the crypto industry, the companies that are publicly traded on stock exchanges that are leading in the development of cryptocurrency or blockchain technology. That can be mining companies that are mining Bitcoin, and that's basically the only thing that they do. Of course, they're going to be very tied to the price of cryptocurrencies. That could be companies offering hosting services for that mining equipment. It could be the exchanges. We were just talking about Coinbase, but there's several other exchanges around the world that facilitate the trading of cryptocurrencies. And of course, you have the equipment manufacturers, the hardware that is being used to mine crypto as well. All of these companies are playing in the crypto ecosystem, but still exist in the regulated financial world. And you can see that they have different characteristics, but because we were talking about correlations before, I think it's very helpful to just see kind of how correlated are these different segments to to Bitcoin. You can see the miners are probably the most correlated at any given point, because just like a gold mining company is going to be very correlated to the price of gold, a Bitcoin mining company is going to be very correlated to the price of Bitcoin. So a few more insights before we wrap it up here, but NFTs, all the rage these days, non-fungible tokens, particularly in the art world. There's really no reason that NFTs just have to be directed towards digital art, though. In fact, NFTs can be used in the physical world. So one of the areas where we're predicting very high potential growth for NFTs in 2022 and beyond is actually the real estate industry. That's simply owning your registration of your property, the trading of property, the fractionalization of property, meaning you don't want to sell a whole building, you just want to sell a few shares of it. All of that can be very easily done using cryptocurrencies and using NFT technology. We've actually already seen this happen with a hotel in Aspen, Colorado, where they digitalized. They turned the ownership of the hotel into cryptocurrencies, and they sold 20 million tokens representing the market cap of that property. So this was almost just a test case, but you can imagine trillions of dollars in the total real estate space that could be turned into NFTs to smooth out that ownership, to facilitate kind of cleaner transfer of property when someone buys it or sells it to another person, as well as to fractionalize it so that multiple owners can be involved. Similarly, I think the world has gotten maybe a little bit too narrowly focused on just the cryptocurrency side of things. And of course, it might be with good reason. We've obviously seen some cryptocurrencies do very well in the last few years. But beyond cryptocurrencies, blockchain technology can be used in a lot of different ways. We think 2022, again, the inflection points, we've seen so much money invested into blockchain technology in the last few years that we're going to start to see these other use cases come to fruition. One use case that I think will be particularly helpful is going to be in supply chains. So you can imagine a case, and this happens seemingly with too much regularity these days, that there's an outbreak of E. coli in a certain food, and they have to track where that outbreak happened from. So they see the outbreak, maybe the outbreak is in New York. They do some sort of tracing where they trace that most of this came from a certain supermarket, that all those people in that supermarket brought a head of lettuce, and then that head of lettuce came from California, and they can finally track it back to the farm where that E. coli outbreak occurred. With blockchain technology, instead of that taking weeks to figure out and potentially being much more harmful to the community with people being infected with E. coli, that they could track this down within a matter of minutes, that every piece of that supply chain is tracked and accounted for, so that from who grew the crop, how it was transported, who was distributing it, to what supermarket it was sold to, and then ultimately closing the loop, who was the consumer that actually bought that. That type of supply chain integrity can improve public health. For the E. coli example I just mentioned, it can help verify just the quality of plants. So if you really want to know if something is organic, being able to completely trust that it came from the farm that you believe it came from. It can make sense in more kind of luxury capacities. So if you're trying to track whether a fancy watch is legitimate, or if it's a knockoff, using blockchain technology can help ensure that quality as well. So as we see these supply chain disruptions around the world, as we see these healthcare outbreaks, as we see, kind of a bigger and bigger challenge between defining authenticity versus fakes, blockchain technology can play a very key role in ensuring the integrity of supply chains going forward. So we just see a ton of different use cases for blockchain. Again, I'll share another survey here. Interesting to note, the vast majority of investors see cryptocurrencies as occupying 0 to 10% of their portfolio. So going back to our discussion around institutional investors and the low correlation aspects, this shows that a lot of investors see cryptocurrencies as that alternatives piece of their portfolio that's going to be kind of more of that diversifier right now. You can also see just how many people came into cryptocurrencies in just the last couple of years. About 62% came into cryptocurrency in the last 2 years. So a very, very new market that is still rapidly changing. We do another forecast for the growth of cryptocurrencies. It's a 47 trillion hit. If we look at kind of the total financial wealth picture, we believe by 2030 we'll go from roughly it's more like $2 trillion market cap today, to about a $10 trillion market cap as we see more adoption of cryptocurrency as that 0 to 10 part of someone's portfolio. So Nadini, maybe I'll pause here because now I know I'm going extra long, but wanted to make sure we touched on the blockchain and cryptocurrency theme as well.
Thank you very much for this, Jay. And yeah, please, the report is available on Charted Disruption site. So please, if you're interested further, you can go through the report in full. But thank you very much, Jay, for sharing those insights and really walking us through how to think through the adoption. And so maybe to kick off the panel discussion, I think the points on inflection points that you made are really interesting and something, that as investors, people would want to figure out, okay, how do I think about those inflection points? So for you and for an average investor, how do you, I saw on all of your charts, you have the innovators, you have the early adopters, then, the majority, and then the late adopters, right? And so how would you, advise an average investor to think about the inflection point or to understand it and where they should sit or read such trends?
Yeah, it's a really great question. So I'll bring up this slide again because I'll reference some of these things. So yeah, so the S-shaped pattern of adoption, it really is kind of the most useful tool we have in thematic investing because there's so much information on such a simple chart here. Further to the left, if you see a dot that is in the innovators phase where there's very little adoption and so much growth ahead, it really is signifying high growth, high risk. That this technology is still going to be very early, that it hasn't necessarily been commercialized, that it's probably not profitable yet. Not a lot of people are using it. So there's a lot of different paths that technology could go. Of course, it could see its entire growth cycle, and it could see that growth cycle very quickly and be a phenomenal, growth story. Or the technology just doesn't make it. There's not enough value to it, not enough support for it, and you could see it not really fulfill that entire adoption. Whereas if you look at themes that are already kind of further to the upper right-hand side of that S-shaped adoption curve, you've seen broader adoption. And that means more stability, more monetization. It's like, a technology that's not going to disappear overnight. A good example, technology that's already in the laggards phase is social media. It's been around for 15 to 20 years at this point. 84% of US adults have a social media account. Social media companies aren't even trying to get more users anymore. They're just trying to further monetize their users. So that's what a mature theme looks like. A less mature theme like blockchain right now is just how do we come up with a use case of this technology that people want to spend money on? That's the phase that we're in for blockchain. So if you're an investor considering these different themes, the first thing you should realize is this high risk, high reward, or is this going to be lower risk, lower reward, depending on where a theme plots? I would say the other thing to be aware of is don't confuse the adoption curve with the hype cycle. The adoption curve is what we see right now, which is literally just how big is the total addressable market, how much of it has already been penetrated. The hype cycle is completely different. The hype cycle is how big do people believe a certain technology could be over time. And what you tend to see is it almost looks like the S-shaped pattern here, but rotated 90 degrees. That sometimes it's in the earliest phase of a technology that the hype is the highest until the hype actually starts to die off and adoption starts to pick up. So people need to be careful of not confusing all hype and over excitement around a technology if it's not proven and not adopted. That's probably the most important takeaway for investors.
Thank you. And Freddie, I know, we think a lot around risk when we look at thematic portfolios. So, what would your advice be, and how do you see it actually in terms of where StashAway investors and where we aim to actually ensure that, people are getting into what they know?
Well, this is a great chart. In fact, I've stolen a better chart than what Jay is showing now, also from GlobalX, because that chart also listed the exact thematic sectors along this S-curve in dots, classic orange dots plots, my favorite. And again, like Jay says, we are too early on the left side of the S-curve, not proven, the innovator stage of risk is highest. Early adopters, yeah, maybe better risk reward profile, but early majority is important too. So ultimately, all this part of the S-curve represent your risk profile, right? And hence, I think it's important for StashAway to curate a team, a super team or a mega team, so to say, that you think is going to change the world in the very long-term future, but you still got to drill it down to the sub-teams. What's the actionable sub-teams within the big team? So in the case of tech enabler, you can define it in many vague ways that's useless. So you got to go and start spreading the seed, looking at a portfolio from which of the sub-teams are at what part of this S-curve right here. And you try to diversify, mix them up. So that's a first line of defense in portfolio construction for investing in a long-term thing like a team, right? So that's the first stage. And to answer your question in a more classic StashAway term is that we also believe that a team sometimes, because its nature is early and is less understood, valuation may be mispriced, the volatility of it, the path of it getting to that final place, that beautiful place we want to be, it can be rocky. So we do recognize that. And we feel that it's not fair for investors to be cut out from a team that has huge promises because of market volatility. Market volatility is basically a reflection of market's lack of understanding in something new, right, at some point. And so we sort of mix in a lot of so-called balancing assets or protective assets in the mix with the thematic assets, so that overall as a portfolio, we can replicate our users' risk profile the classic StashAway way. 6.5% VAR to 36% StashAway risk index is all been generated by this approach, so that a user is not cut out of this very exciting field because of risk profile, because of market volatility.
Yeah, thanks, Freddie. So here, it came out a few days ago that in Singapore, we are set to launch flying electric taxis by 2023. And this is mainstream media. You see the news out there. How do you think such futuristic innovations and them actually being put out in mainstream media affect investors' behavior, and what does it mean these things actually concretely coming into effect, becoming reality? So much that we can say, in 2023, one of us is going to be in a flying taxi at some point of time. Jay, would you like to start?
Yeah, I mean, so one of the great things about thematic investing overall is that it's tangible. It's happening in the real world. In the investing world, a lot of stuff exists on spreadsheets and it doesn't exist in the real world. I mean, try to feel, value stocks or try to see, momentum stocks in real life. It's hard to do that, but you can see themes happening all around you. Two of the themes that we've mentioned, robotics and artificial intelligence and electric vehicles. There's nothing stopping anyone from, owning a Tesla or seeing a Tesla on the street or having a robotic vacuum cleaner. These are products that exist and are starting to see adoption. So I think it's great that investors can see these themes in the real world and in many ways kind of evaluate them, based off of their real world experiences. A lot of the new technologies that people are talking about, we will experience, soon in our lifetimes, but they're going to be strange, whether it's, electric, air taxis, whether it's just simply driving in an autonomous taxi going forward. These are going to be unusual steps for us. These are going to be new technologies that we might not be totally comfortable with. But I think it should help investors that they can experience it in real life if they decide they want to put it in their portfolio or not.
So in that context, Freddie, at the moment, some people think that the markets are now priced very high. In particular, technology has already priced in a lot of future growth, and people start to think about the right time to invest. What would be your take on it?
Again, I go back to what Jay's mentioned before about the hype cycle versus the actual adoption cycle. A lot of this, especially social media, the hype cycle is at its maximum. They're just still milking the cow. There's nothing new anymore. And hence, I would say the valuations there could be concerning. But once you look to the left side of this beautiful chart, you start finding interesting stuff like lithium, battery tech, genomics, immunology, robotics and AI, and all is somewhere in terms of somewhere between early adopters and early majority. So that's where the gems are, right? And so I think valuation has something to do with where you actually sit on this S curve right now, on this adoption curve, and versus the hype cycle, right? So that's a summary. But I also would say that you can never really use market price or traditional metrics to evaluate the valuation of something that's disruptive, because the history is not doing its fair share of representation. Because for example, a pie is always expanding. New businesses are being destroyed, disrupted, but new businesses are being gained and created by the disruptors. So we don't have enough history to look at this expanding pie. And it's the same thing with the blockchain and cryptocurrencies. The people don't look at price earnings ratio because there's nothing that back up the tokens. That's one of the criticism people say, but it's sort of taking it the wrong way, in the sense that when it comes to cryptocurrencies, blockchain and networks, it's about the network. The amount of node point activities among the active addresses in the network is about the amount of transaction that can exponentially increase because of the network. So interested users should definitely find out more about what is the McAfee's law. It's the Moore's law equivalent of how to value an expanding network. It actually do very well than traditional discount cash flow analysis on companies. If you use it on companies like Tencent, Facebook, Amazon, anyone with a marketplace, a network of a serious user that transact among themselves, the McAfee law actually stated that the value of the network is square, proportional to the square of the number of active users. So you gain more people, they go square up. You will start losing people because of competition, you go square down. So by design, they are volatile in the meantime until they are mature. So it pays to pay attention to these things. And all of it has to do with being on the left side of the adoption curve. The McAfee law applies more than price earnings ratio. So I'll take a sort of a outside the box approach to analyzing value. And hence, I think the McAfee law, under that framework, a lot of stuff we felt expensive, they are nowhere near where they should be in 10 years from now. So valuation being expensive is sort of just an optics in a lot of cases.
Okay.
Back to you, Jay.
I'll take a couple of questions that have come in. So maybe the first one is, with all the jobs being replaced by robotics and AI, I think what the attendee wants to say is that there's an impact on, jobs, income, and therefore, how does that roll into, companies? Who are companies going to sell to? What the stock of companies is going to look like? It's an ecosystem of input and output. And so how and what proportion of companies are going to make money or sustain or be sustainable in making money?
Yeah, it's a really good question. So a little bit of the misconception about robotics and AI is that entire jobs are going to go away because AI is going to take them over. One of the people that we worked with on this report, Eric Brynjolfsson, studies this in academia and has really interesting insights. But basically what he figured out is that while almost every job has some tasks that can be automated, there's very few jobs where all of their tasks can be automated. So it means that there's going to be a changing nature of jobs. What we do in our day-to-day is going to evolve as we can use more automation, but the entire job is not going to go away. You can see some examples here of kind of the most automatable and least automatable jobs based off of their assessment. But yeah, so basically the idea here is that we're going to use robotics and AI as a tool to help us do our jobs better, and frankly, to probably get rid of the parts of our jobs that are the most tedious and least interesting, rather than fully replacing kind of entire people. But we also see the robotics and AI theme as having kind of a relationship with another theme going forward, which is going to be the education theme, which is if you have more and more AI being put into jobs, you have to be able to kind of prove your worth in that job as a human, right? And the most human theme is being able to learn and to be creative and to be able to make decisions based off of, uncertainty. So we believe that robotics and AI is not likely to create massive widespread job replacement, but it is going to put a greater emphasis on people to continue to further their educations, that there's kind of this separation between the basic stuff that robotics and AI does and the more complex, nuanced things that humans do.
I would just add that I do agree, and I do, not don't, I do. But I want to just remind people that there's an aged population demographics going on in a lot of developed countries. So the amount of aged is getting high, and the new workforce is coming in is a lesser base. Maybe it's not true for developing countries, but what it means is we can actually afford a bit more disruption than before, because society do need to maintain the same amount of output with less people, less productive workforce. So there's one macroeconomic trend that actually would benefit from more automation. However, there's some reality check I want to say as well. It is true that there are people that will be disproportionately affected. They may be disrupted more than others. Some will gain, some will lose. And hence, investors should take care, because a very traditional portfolio with very traditional assets, you actually faces a risk that's not quantifiable today. The risk of being disrupted faster than before. Businesses are dropping out of the S&P 500 index at a greater pace than before. Tesla came in, ExxonMobil went out last year. So your portfolio actually needs to start hedging, start creating insurance about disruption. I'm not going to sugarcoat it. It's not going to be smooth. Some people will get caught in it badly. Some people will win. Overall society improves, as according to Jay. But our portfolio needs to respond as well. So having thematic investment that focuses on innovations, disruptions, is a great way to hedge your portfolio against ever increasing speed of disruptions. So I just want to put it out there.
Thank you. So we have another question, which is interest rates are happening soon. How will it impact investing? Freddie, do you wanna take that?
Interest rates are always going to go up and go down. What matters is not where they go, but the amount that the market has already priced in versus what's not. So you can, traditional speech, not so innovative here, but treat investing as like a room full of 100 people. And if only 10 people are prepared for it, the other 90 is not, we have a problem. The market will drop. But if everybody has talked about it, hasn't happened yet, and when it happened, actually didn't matter, right? Because everybody has prepared for it. So the market is forward-looking, and so is the interest rate market. When Powell a couple of weeks ago announced a faster amount of rate hikes, 3 times next year, 3 times the year before, the market actually went the other way. It was worried before that, but when the announcement came, the market went up. So it pays to prep the market in advance of an action. And that's what the Fed has done very well. So we're not so worried about this interest rate cycle because it's very well managed, well communicated. We should worry more about inflation that cannot be fought by interest rates. Hiking interest rate, I fail to see why it can slow down the supply chain disruptions. Hiking interest rate, I fail to see why because of another lockdown, ships are out of the port, unable to unload cargoes, hence prices go up. I fail to see why interest rate hikes would help. And I think the smart people at the Fed knows that too. It's not just us. So it will be measured. It's already, a lot of it is priced in. That's the good news.
Great. Thanks, Freddie. Jay, there's another question for you, which is, when it comes to electric vehicles and robotics, do you foresee a scenario where there could be an oversupply, which consequently impacts prices and valuations?
I think it's pretty unlikely. I mean, certainly in the electric vehicle space, we're actually in undersupply in some very critical pieces of that market. I mean, certainly we're in undersupply of semiconductors right now, but more structurally over the next 7 years, we're in undersupply of lithium, which is the key input to lithium ion batteries. And we're talking about
think latency.
Sorry, yeah, I think Jay's internet.
Jay, come back.
in electric vehicles. Similarly, within the robot, I think it's going to be unlikely that we see oversupply there as well. Right now, it's still it's hard to put robots to work in the sense that there's a entire industry that specializes in helping, kind of, they're consultants that basically help factories use robots. So there's the people that build the robots, and there's the factories that want them, and there's these kind of middlemen in between that are helping facilitate that. It means that the sales process for robots tends to be long. It means that implementation takes a bit of time. Of course, with advancements in AI, we're hoping that that gets smoother and cheaper and faster. But it's still a very kind of nuanced business to business area. It makes it very unlikely that robots are going to be oversupplied, because the robotics manufacturers kind of know how many robots to build well ahead of time.
Okay, thank you. I see a raised hand from David. I'm afraid, I think, David, you will have to write your question into the Q&A. Sorry. Great. We are just at the hour. Thank you so much, Jay, for sharing your insights and bringing color to this report, which really I think is going to be a really, really great read for a lot of people over the Christmas holiday weekend. If you don't have something else to read, I did read it over the last weekend, last weekend. So do look it up. It is a very interesting read. So thank you so much for joining us today. Thank you, Freddie. It's really been great to have this topic come out. There are just so many questions that come to us at StashAway, and it's really nice to have a broad understanding of how to digest all of this information. So thanks very much for joining today, and thank you to all the attendees as well for giving us your hour. We hope this has been helpful for you. If you do have further questions, please do feel free to write into the StashAway client engagement team. They are always happy to get you the answers that you need. So with that, happy week for everyone and happy holiday season. Thank you.